hi again, everyone. This is going to be the fourth in our 5-part series of our back to school, kind of brushing up on your finances for the fall. And for those of you who didn't join in the last couple of weeks, my name is Lauren Anastasio. I'm a certified financial planner here at SoFi. And my job essentially is to provide financial advice to our members and just be here as a resource for all of you as you transition large financial events in your life, like buying a home. So with that in mind, I'm here today to really talk about home buying, not necessarily home ownership, but just the process and kind of understanding what does this really entail and learning a little bit more about the practical aspect. So how much can I actually afford? How to best prep my finances? And with all of the relocation that people have been doing, we felt that this was a pretty timely subject. As a brief reminder before we jump into our content, while I am a certified financial planner, this presentation is not designed to be a form of personalized advice. So as always, please refer to this more as education. And before making any big financial decisions, please make sure that you're consulting the right professional, whether that's a legal professional, tax professional, or otherwise. We do have a ton to cover today, and we also have a big surprise for you towards the end of our presentation, so please make sure to stay tuned. And I also know that we had a ton of responses when we asked what questions you have, and I'm going to do my absolute best to get to as many of those as possible. If you did not have the opportunity to add a question when you registered for today, please feel free to add a question in the Q&A or the chat, and we will do our best to get to those as well. But without further delay, I want to jump in so we can cover all of this amazing content, leave time for our surprise, and all of your questions. As I touched on, we're going to go through a couple of high-level topics today to really help you understand what it feels like to buy a home. First, we're going to touch on affordability. So a really big component to this, and from my perspective as a fiduciary, I want to make sure that we're going through this process understanding exactly what we can afford and ensuring that homeownership fits into our lifestyle, fits into our budget, and that we avoid a scenario where we become house poor. We're going to talk a little bit in terms of kind of administrative and organizational tips that you can take to start preparing your finances, whether your home acquisition is 2 months from now or 2 years from now. There are still things that we can be doing today to make sure that we're on track to meet our timeline. We will talk a little bit about the different types of mortgages, so how to choose the right product and the right lender for you. And then we have a surprise for you. So in terms of affordability, so when we talk about a price range, there are a few different ways that you can approach this. And our recommendation is to start by thinking about 2 numbers. First, the cash you have on hand, and then secondly, the cash that you earn. So what you have and what you earn are going to be the 2 most important components to what you can afford. When it comes to cash on hand, the reason this is so important is because you will need liquidity for a down payment. And when I say cash on hand, this also includes marketable securities. So one of the questions that we got in advance was in regards to investments. Can I leverage investments in a brokerage account for my down payment? The answer is yes, absolutely. You would need to liquidate those investments for cash prior to the actual transaction, but any taxable investments, marketable securities that you have can be used for this purpose. The down payment itself can fluctuate. So a minimum down payment is going to be somewhere between 3.5% to 5%, which is going to depend on the type of loan that you acquire. 3.5% is usually the lowest down payment that you could get with an FHA loan. And I'll go into a little bit more detail about what an FHA loan is, whether it makes sense, how it's different from a conventional mortgage. But that would be likely the lowest down payment that you would be able to find with a mortgage product. 5% is typically the lowest down payment that you could use for a conventional mortgage. In either scenario, PMI or private mortgage insurance would be applicable. Private mortgage insurance is essentially a separate insurance that you, as the homeowner, pay for in order to protect the lender. So lenders take on a certain amount of risk when they lend to you to buy a home. And if you put less than 20% down, so you have less than 20% equity in that property, the lender wants a little bit of extra assurance that if you were to default, they would get their money back. So they get this through that private mortgage insurance. And that amount of PMI that you're paying will vary significantly. The cost of the PMI, it's a monthly cost and it's included in your mortgage payment. It's determined by a few different factors, primarily your loan amount, and then it's further calculated based on your credit score. So some people who have PMI might be paying a few $100s a month. Others, depending again on their loan amount and the quality of their credit, might find that their PMI expense is $50 or $60 a month. So the cost of private mortgage insurance or PMI does vary significantly, but it isn't necessarily a deal breaker. A lot of people are panicked that if they don't have 20% down, they're going to be penalized by having to pay PMI on their loan. The reality is, while you likely will have to pay that private mortgage insurance, the cost may be manageable enough that it's still going to be attractive for you to go through that process, even without the 20% down payment. One of the questions we received in advance was, I live in the Bay Area. What am I supposed to do if I try and save 20% down? I could be saving for the next few years. And again, the reality might be that the trade-off between that monthly private mortgage insurance versus waiting a few more years paying rent and seeing property values continue to increase, you may actually save money, or it might be more attractive to you to get into a property now, pay that private mortgage insurance as an additional monthly expense before property values and interest rates rise. Keeping all of that in mind, 20% down is ideal in general. You will eliminate the cost of the private mortgage insurance, and it may help you qualify for the best possible rate. So the larger the down payment you're able to make, the less risky you are to the lender, therefore the lower the interest rate they would be willing to offer. Not to mention, the more you're able to put down, the less of the total cost of the property that you're financing. So your mortgage costs will be much lower and your overall cost of ownership will decrease. In addition to your down payment, you want to focus as much attention on the cash to close. So if you get a loan estimate, or you go through the pre-qualification or pre-approval process and you're looking at a loan estimate document, you'll see a couple different numbers. Your down payment is calculated as a straight percentage of the purchase price. Your cash to close, though, is going to incorporate all of the additional costs, so fees and taxes that you have to pay out of pocket upfront in order to go through that transaction. So this will be inclusive of your down payment, and generally speaking, will add an additional 3 to 5% of the purchase price that accounts for things like transfer taxes, appraisals, underwriting fees, application fees, prepaid escrow, a title search. The list goes on and on, but much of this is just the nature of the transaction and usually unavoidable. And the percentage that you would pay is going to be heavily dependent on the location where you're making the purchase. So a lot of these taxes and costs are going to be based on either the city, county, or state where you're making that purchase. So it is really difficult to say exactly what you can plan for on a universal basis. Separately, we do also always recommend that you anticipate an additional 1% of the purchase price in incidentals. So something like an inspection, and you might have multiple inspections, whatever the case might be. These are all fees that you as a buyer will have to pay for out of pocket, and they're not included in your closing costs. So you do need to be prepared to write a few checks and have some additional cash outlay as you go through the transaction. But essentially, cash on hand, inclusive of your down payment and all of your cash to close, will be one factor that helps you decide how much you can afford. So what you have available, what percentage you want to put as a down payment is going to help determine the price range that you're going to fall in, or what you can technically afford. In terms of what you're able to use for the purposes of a down payment, I know I touched on this briefly, but generally any cash that you have in checking and savings, any marketable securities like that you might have in a brokerage account, vested restricted stock, assuming that you work for a publicly traded company and that the stock is eligible to be sold. So you're not in a blackout period, you're not in a private institution that the stock is in fact liquid and marketable. Effectively, can you sell it for cash before you close will be what helps you determine if that's something that you could use. Loans from qualified plans. So you can use a loan against your 401k or 403b if your plan allows it to borrow cash for the purchase. Retirement accounts in the form of IRAs. You can make withdrawals from these investment accounts. They will be taxable, potentially taxable and penalized depending on the circumstances. And I won't get too much into that because there are a lot of nuances. But if you have IRAs, assets in IRAs, you can potentially use those for the down payment as well. And gifts or loans from friends or family members would also be a potential area of down payment sources. So if you're expecting a gift from a parent or a grandparent or in-laws, we would just want to see that documented. So some type of letter from the donor explaining that this is a gift, how much they plan to give you, and that there's no expectation that that money would be paid back. Sources that you definitely cannot use for a down payment, credit cards, any sort of cash value of an asset. So something like if you own a car, cannot use that. Mattress money. I know this probably sounds a little bit like a joke, but a lot of people earn cash or save cash. So if you have a job where you earn cash, if you work in food service, or you just been saving up cash and hoarding it somewhere in a duffel bag, this cannot be used for your down payment. So if this is applicable to you, please make sure that you're depositing any cash that you have into a bank, because there will need to be a record that funds that you're using for your down payment have been in a bank for a minimum of 3 months, in some cases 6 months, depending on the policies of the lender, in order to be counted towards what you would have for a down payment. Same goes for any unvested company stock, or people often ask about stock options. Stock options are not marketable securities. If you have options, you may be able to exercise those options in order to purchase the stock and then sell the stock, assuming that you work for a company, again, where the stock is marketable and liquid. But if you're unvested, we can't use any of those assets towards your down payment. And then the second factor of affordability is your cash flow. So how much you make relative to how much you spend. So from a budgetary standpoint, we want to make sure that your housing payment is going to fit into that budget. When we think about your monthly payment, we do want to look at what's called your PITI, P-I-T-I, your principal, interest, taxes, and insurance. This makes sure that you're really not overlooking any large expenses associated with that home ownership. And we use a couple of different calculations to help you decide exactly what mortgage payment you can afford. From a fiduciary standpoint, we would love to see you using this front end ratio, which is taking 28% of your gross monthly income. So let's say you make $100,000 a year, you divide that by 12. Again, this is pre-tax, and then 28% of that number, that's where you would want to cap your PITI payment. So your principal, interest, taxes, and insurance should ideally be no greater than 28% of your gross monthly income. The back end ratio is looking at all of your consumer debt. So if you have student loans, if you have a car loan, maybe some credit cards or other types of debt obligations, the back end ratio is really looking at, can you afford all of your obligations? So we like to cap this at 36%. So this would mean that 36% of that gross monthly income number would be able to cover that mortgage payment, the PITI of your mortgage, plus any other monthly payments that you're currently responsible for. We're less concerned with the total amount that you have outstanding. The main priority is your monthly payment. So let's say you have student loans and you're trying to figure out, can I purchase a home even though I still have student loan debt? An underwriter, and even from a financial planning standpoint, we're less concerned if you have $20,000 of student loan debt or $200,000 of student loan debt. What's most important is what your monthly student loan payment looks like. Again, desirable to be at no greater than 36. If you do live in a high cost of living area, like the Bay Area, New York City, Washington, D.C., Seattle, and you don't have any of this other consumer debt, so you've eliminated student loans, you're not carrying credit card debt, you don't have a car loan, then that gives you a little bit more wiggle room, a bit more of a buffer to go up to a maximum of 36% on housing. The 40 to 42% I put in here because you should all be prepared that when you go through the process with a lender and they tell you that you're pre-approved or pre-qualified for a certain purchase price, they're going to give you a number much higher than what I would give you. So they are comfortable going up to 40 to 42% of your gross monthly income. Remember, that's before taxes. What a lender is basically doing is trying to figure out what is the maximum amount that you could possibly afford. What is the maximum dollar amount that they could lend to you and you can still feasibly make your payment? From a fiduciary standpoint, as a financial planner, I'm aware of the fact that home ownership is not your only goal. So I want to make sure that you can afford a desirable home with a lifestyle that you like, but that you can also save and that you don't need to only eat ramen for 5 years in order to be able to afford your mortgage payment. So please keep in mind, ideally, 28% would be your front end ratio, your housing payment. Your total consumer debt would be capped at 36%. For those of you in higher cost of living areas, this may give you a little bit more wiggle room in terms of purchase price or what your monthly housing payment could look like if you've avoided other types of consumer debt. But as always, a lender will likely offer to lend you more. So if you do see a loan amount that's higher than what you've calculated you can afford for yourself, this is why. Okay, so I'm going to pause for a quick second. I know we have a ton of questions already, but if you do have questions throughout the presentation, please absolutely pop them into the chat. We will do our best to get to them. So I don't want to forget anything that we're covering. I know we're going through a lot of content. And there are undoubtedly a lot of questions that are arising. So when we think about getting our finances ready, there are usually a few things that we would like to be able to do. We want to figure out how much we can afford. So we just kind of talked about those calculations. What do we currently have cash on hand? If we haven't saved up that amount yet, how are we going to save in order to get there? And then thinking about how to budget in order to make sure that saving is easier or that we're best able to afford that payment. And we also just want to make sure that our finances are clean and in the best order possible. So creating a budget for where you are currently will really help you identify areas where maybe there are things that you might be able to cut out from an expense standpoint to ensure that you can either save up for the down payment or once you get into your home are more comfortable with your mortgage and housing payment moving forward. But maximizing your cash flow by eliminating monthly obligations will help you essentially more comfortably afford a housing payment. Reducing high interest rate debt is hugely valuable for a couple of reasons. One, by not having credit card debt or personal loan debt, you will essentially be saving money. So anytime we can get rid of higher interest rate debt, we'll save money on the accrued interest. But we also know that paying those off, if you are carrying balances, can help boost your credit score. And getting a higher credit score can help you obtain a better, lower rate on a mortgage. And remember that your credit score will also determine the price of your PMI, that private mortgage insurance. So your credit score is factoring into the ongoing cost of your mortgage in multiple ways. Then when you think about either saving or investing, you really want to focus on your timeline. So for those of you who are thinking about going into homeownership in the near future, and by near future, I really do mean anything in the next 3 years, the ideal place to put money that you're setting aside for this home purchase is going to be in a savings account. I know that interest rates are ridiculously low right now, and the concept of a high yield savings account seems like an oxymoron, but you're going to be far better off putting your money someplace where you're not taking any risk at all and making sure that you're getting your return of your capital, much more important than focusing on the return on your capital. So short-term goals, cash savings is going to be best. If instead, though, you think homeownership is definitely something that you want to do down the road, but maybe not for another 5 to 7 years, anytime you're looking at something that's more than 3 years into the future, then we can start to consider investing that money. Is it possible that you could see appreciation on your assets and investments in less than 3 years? Absolutely. But it is also possible that you're going to invest and then the market's going to go down. So we always want to make sure if you're making that investment that you're going to continue to be invested long enough to rebound from any downturn. And then from a credit perspective, there is always concern about, what credit score do I need? What is the minimum credit score? What if my credit's not great? The thing to keep in mind is, yes, credit is important. But if you don't have terrific credit, it's really not the end of the world. There are mortgages out there that you would be able to obtain even with a credit score as low as the high 500s. And we'll talk a little bit more about that when we get into the different types of loans. But the higher your credit score, the lower your cost and the more variety of loan options that will be available to you. So keeping your credit score as high as possible would be great. A 760 or higher is generally considered excellent. So if right now you're at like a 790 or an 800 and you're just like trying to do everything you possibly can to get your score to go up to like an 820, you're probably spending a lot of unnecessary effort. You're likely already in a range where you're going to get the best possible rate. Boosting in another 20 points is probably not going to do anything for you. But by all means, please continue doing what you're doing in order to keep your credit up. We do want to make sure that in terms of making sure our credit is on track for a home purchase, that we're making on-time monthly payments for all of our debts. hopefully paying off credit card balances in full. If you do manage to pay off some debt that you've been carrying, try to avoid closing any credit card accounts that have a $0 balance. So if you've paid it off in full, you may not necessarily want to go ahead and close that account. It is possible that a lender will ask you to do that, and we can kind of get into that later in the discussion, but we do want to generally try to avoid closing accounts unnecessarily to keep your length of credit history longer, as well as the amount of credit that's available to you. We do want to avoid applying for new debt. So the 3 to 6 months leading up to your home purchase, try to avoid taking out any other lines of credit. So for example, if you're going to shop for a new car the same time that you're moving, maybe you want to try and plan to do that car purchase after you move into the home if you're going to finance it. Or if you plan on taking out a new credit card, wait until you're already in the home before going ahead and applying for it. And then credit score monitoring, really easy these days. So very easily accessible. SoFi offers free credit score monitoring through our Relay application, which is in our mobile app as well as on the website. There's absolutely no cost and your score is updated weekly. This will give any of you who are trying to keep an eye on your score or boost your score up over time, resources to really understand what's impacting your score and how to make sure it's where you want it to be before you go through that transaction. Okay. So there are an abundance of different loan types, and I just truly don't have the opportunity to go through every single one, but I'm gonna cover what I feel are really the most important concepts or features of different mortgages so that we can understand how to start shopping around for the best loan. Fixed rate loans, undoubtedly most popular, especially a 30-year fixed is without a doubt the most popular loan that first-time home buyers enter into. Reason being, it is going to have the lowest monthly payment and it's going to be very predictable. So for those who are just trying to get into home ownership, we're scraping together what we can for a down payment, and we know that we're probably earning a little bit less than we will be in the future. A 30-year fixed is going to give you the lowest monthly payment. 15-year fixed is also an option. Of course, you're looking at a payment that's going to be almost double because you're trying to pay off the same amount that you're borrowing in half the amount of time. But both of these will come with a fixed interest rate, which means not only are you fixing your interest rate for the life of the loan, but you're fixing your mortgage payment, which makes things a lot easier for planning and makes things far more predictable for you. It is important to note, though, that your mortgage payment, that PITI that we talked about, principal, interest, taxes, and insurance, may not and likely will not stay consistent for the life of the loan. Whether you borrow a 15-year or a 30-year, your taxes are the area where you have the highest likelihood of change. So you may have a very predictable principal and interest payment, but your taxes have the ability to jump up or down in any year, depending on your local property taxes and any assessed value. So keep in mind that even going with the fixed rate product, the actual monthly obligation will potentially rise, will likely rise over time. Insurance costs likely also will rise, but usually not at the same cadence or the same appreciation rate as your real estate taxes. An adjustable rate loan is kind of a hybrid. So an adjustable rate means that you have a fixed rate for a short-term period of time, but then your rate has the potential to adjust after that fixed rate period. So most adjustable rate mortgages are still on a 30-year total payment. So if someone offers you a 5-year adjustable rate mortgage, 7-year, 10-year adjustable rate mortgage, what that really means is for that 5-year period, 7-year period, or 10-year period, your interest rate is locked. But after that 5th year or that 7th year or that 10th year, depending on which one you choose, your rate has the ability to adjust. And the way that it works is it typically will adjust once per year, either up or down, depending on the interest rate environment at the time. An adjustable rate mortgage can be an excellent solution for someone who has assets available for a down payment and maybe is pretty confident that they're going to be in a property for like 5 to 7 years, but they know they're not in their forever home. So maybe you live in the Bay Area and you want to lock in your costs because you just see rent prices continue to rise year over year, and you have assets available for a down payment, but you also know that 7 to 10 years from now, you really want to relocate somewhere else, or you want to move back home, or you know that you want to be in the suburbs or doing something else, or you want to go abroad. Whatever the case may be, an adjustable rate might be attractive to you in that case because you're less concerned with what might happen to your rate 10 years from now, but you want to lock in the best possible rate you can today. So those adjustable rate mortgages will often come with a lower upfront rate that's just locked for a shorter period of time with the knowledge that it can adjust either up or down in the future. Similarly, interest-only payments will work the same way. An interest-only payment is usually also an adjustable rate mortgage where you only pay the interest on the loan, no principal, for that preset period of time. So you might have interest only for 7 years, you might do interest only for 10 years, and then in the next year, you go into full principal and interest repayment. The downside here is that these types of loans typically do require a much higher down payment. So again, this could be really attractive for someone who knows that they're in an area for a short period of time and has the assets available to make a 20 to 30% down payment, but also knows that there's a high likelihood that they're either going to relocate or upgrade that property, even refinance it in the future. Then we have kind of the process, right? So let's say we know that we want to be homeowners. We've figured out exactly how much we can afford to buy. Our finances are in order. We have an idea of the type of product that we want. What now? So like, what is the order of events? What do I do? Very important to realize that from a financial perspective, we have a pre-qualification process and then a pre-approval process. These sound very similarly and are often mixed up in terms of vernacular, but are very different in terms of what they mean and what they require of you. The pre-qualification process is basically a lender's way of saying, hey, based on the information you told me, I'm pretty sure that we would lend to you $800,000. It is extremely non-committal. You're basically providing information to a lender, and very quickly on a high-level calculation and a sneak peek into your credit, they're coming back and saying, based on the information that you've provided to us, without too much due diligence, we estimate that we would be able to lend to you X. So pre-qualification, very high level, but can be very helpful for you as a starting point. So pre-qualification can be recommended at any point throughout the process. If you think you're 6 months, a year, 2 years out from making a purchase or going through the transaction, a pre-qualification is something that you can do at any time. It's also something that I recommend buyers do before getting engaged with an agent. An agent will want to know that they're working with someone, with a buyer who is desirable to a lender. So a pre-qualification gives an agent a peace of mind that they're working with you and that based on your credit and what you've indicated your finances look like, that a lender would be willing to lend to you and they have an idea of what price range would be realistic. Beyond that, we then have pre-approval. Pre-approval is very different. It does involve full underwriting. It's basically the equivalent of going through the mortgage application process, the same as you would once you've made an offer. You will go through a hard inquiry on your credit, you and anyone who applies on the loan with you. And you will have to provide significant documentation. So at a minimum, your last 2 years' tax returns, copies of your recent pay stubs, copies of statements for all of your assets that you plan to use for your down payment for the last few months. An underwriter is going to go through everything with a fine-tooth comb. They're going to ask you questions, and they're going to verify all of your income and your assets. Then a pre-approval letter issued by the lender is really their stamp of approval. This is a very powerful tool for you. Pre-approval basically indicates that the lender has done all of their due diligence and they can confirm a hard dollar amount for you. So we've looked at everything we need to look at, and we will go up to X amount of dollars. So based on what we've reviewed, we will lend you $900,000. And this is going to be really helpful when you start making offers on properties. So a pre-approval makes you a more desirable buyer, because if you get into a bidding war and you're pre-approved and someone else is not, you're automatically going to be more enticing to that seller, because there's a lower likelihood that your financing will fall through because you've already been fully vetted by a lender. Additionally, because you've already gone through that full underwriting process, you actually have the ability to offer a shorter closing time. So you may be able to offer to close within 30 days, whereas someone who has not gone through pre-approval realistically shouldn't be offering to close any less than 60 days. So this is a tool that you can leverage for negotiations and makes you a very desirable buyer. However, because of the amount of information that you do need to exchange with the lender and the hard credit pull, which is only valid for 60 days, so does need to be renewed depending on how long it takes you to go through the process. Pre-approval is something that I only recommend once you're getting very serious about searching. So when you're viewing properties and you feel like you're prepared to make an offer once you find the right fit, that's when you want to get pre-approved. Okay, so covered a lot. But we want to make sure that we're focusing on a few different things. So affordability, please keep in mind, and let's be realistic. What do you have at your disposal, or what do you plan to have available in order to make a down payment? And realistically, what do you earn, and what's that income relative to your expenses? What mortgage payment is truly feasible that it can fit within your lifestyle? Then think about your timeline. So when it comes to how much room do I have to improve my credit? Should I be saving or should I be investing for this? Thinking about how many years into the future this is something you want to do, that's going to really help you decide what you should be doing with that extra money you're setting aside for the purchase. And then thinking about how you choose a mortgage product or a lender, we do want to try and be objective. I always tell people to check with at least 2 providers. At a minimum, check to see what you would qualify for with at least 2 lenders. And you want to compare everything, not just rate. So there are other fees that would be involved. PMI is going to vary based on the lender, whether they charge an underwriting fee, an application fee, a processing fee, maybe 2 of those or 3 of those is all going to impact the cost. So make sure that you're not just looking side by side at one rate versus another. Really important too, in that vein, to keep in mind that there are also points or the ability to buy down a rate. And in many cases, if you apply with 2 different companies and you see that one lender is offering you a rate that's dramatically lower than another, they may automatically be including an upfront fee in the form of points to buy down that rate. So you do want to make sure you're comparing apples to apples. And we can talk a little bit more about that if there are any specific questions. But these are my main takeaways for you today. And I am sure you feel like you've heard more than enough out of my mouth, which is why we have this awesome surprise for you. I'm going to let Paige jump in here and introduce our surprise.
Thank you, Lauren. I'm so thrilled to introduce today's special guest. Her name is Jen Saxton, and she has been a SoFi member since 2013 and was one of our very first SoFi ambassadors. Jen is currently living in Los Angeles with her husband, Kern, her 1.5-year-old daughter, Charlotte, and her furry friend, Jackson the Bichon. Jen is a serial entrepreneur with 10 years experience in the baby industry and is the founder and CEO of Tot Squad. In her own words, what Jen likes most about SoFi is that it's more than just a bank. There's so many amazing experiences that I've participated in, like the entrepreneur program, concerts, game nights, and networking events. Jen is a homeowner, and so we're so excited to have her join us today to talk about her home buying experience. Thank you.
Thanks, Paige. Thanks for joining us, Jen. And I'm so excited that I didn't know your dog's name was Jackson, because my dog's name is also Jackson, and I feel extra connected to you. Best puppy name ever.
Oh, it looks like we are having, oh, Jen, are you all set there?
All right.
And then Lauren, if you want to stop sharing your screen, we can see you and Jen a little bit better.
Awesome. Thank you guys so much for having me today. I'm a huge SoFi fan and love talking about personal finance and just tips and tricks and ways to be smarter about it. So happy to be here.
Thank you. So I know that you're a huge SoFi fan and that you've been with us for a while, but we're here to talk about home ownership and people want to hear your expertise and learn from your experiences. So can you tell us a little bit more about when you purchased your first home and a little bit about the experience that you had?
Yeah, absolutely. So we bought our home about 3 years ago. We were newlyweds and thinking about starting a family and had been living in very expensive rent land, also known as Santa Monica here in LA, and wanted to move to a more affordable area with a bigger space to start a family. The biggest challenge for us was that we had non-traditional income. So as a startup founder, my income had varied wildly between not taking a salary some years to putting money back into the company and then sometimes taking it out, and sometimes having business losses pass through on my tax returns that made things challenging. And my husband is a filmmaker, and so most of his income is 1099 independent contractor income. And my tax guy would say we've been very tax efficient. And a lot of the things that he does, like go to the movies in the pre-COVID era, were deductible for us. So we would intentionally make his income appear as small as possible from a tax perspective, which came back to bite us when we were trying to make our income look as large as possible to qualify for a home loan. So I feel like for anybody who's on this call that maybe works as a 1099 independent contractor in the gig economy, things like that, you might want to start thinking about getting really smart with your tax return strategy to boost your income as much as possible. For me, that actually meant moving myself onto a W-2 employee salary with my own company instead of as a pass-through business owner, so that I could show more income than I had been previously. And that was super painful for me to pay payroll taxes just to make my income look more attractive for home lenders. But ultimately we were able to qualify and get it done, so it was worthwhile. But because our income was non-traditional, we had to put a really large down payment down. So we actually did roll over some inherited IRA money from a grandparent that had passed away, and ended up putting down 40% to qualify for our loan, which was just crazy.
I'm so glad you brought that up. One, I know that at least one person who registered in advance had asked about 1099 income and sort of what is a little bit different there. And it is trickier, right? So a lender is going to want to make sure that you have some sort of consistent income, and they are going to look at a few years back for those tax returns. So that's great advice for those of you who have been really strategic from a tax perspective. Maybe you might want to revisit that and see if there are things that you would do differently if you're doing it in the lens of a mortgage lender and you are trying to show as much of that income as you really have coming your way. So excellent advice. You also mentioned, I know that you did wind up having to put down more than you had anticipated. And for a lot of people that might really sway their purchase price or what they think that they can afford. How did you know how much you can afford, or how did you go like kind of calculate for yourself what was realistic for the two of you?
Yeah, I mean, I generally tried to base it on what I knew we were affording in rent. And I kind of knew the rule of thumb is generally 25 to 30% of your income. And I think it's important to make sure that you're anticipating the tax and insurance costs. I'm in California where property taxes are really high. And I think the same is true in states like Texas, where like we're paying $10,000 a year in property taxes. So that's like an extra $1,000 a month. And so if you're just looking at the value of the home and not actually what your monthly expense is going to be from a property tax perspective, you might not have the right number in your head. So really getting a sense for what we could afford on a monthly basis. But, you know, I honestly think that having to put that 40% down, I wish I had done it sooner. You know, if I had put 5 or 10% down and just paid the PMI, I mean, God, when you said sometimes PMI is only 50 or 60 bucks a month, I was just like really kicking myself here because, you know, thinking about the fact that I was spending $30,000 a year plus on rent for like 15 years after college, just like throwing that money away instead of building equity in a home, that 50, 60, or even a couple $100s a month in PMI would have paid for itself if I had been building equity in a home sooner.
Yeah, that's a common kind of hindsight revelation that I hear from a lot of members who just said, oh, I wish, you know, if I had only known then what I know now. But you learned it, and you're going to take that with you moving forward, which is fantastic. And I appreciate, again, you bringing up the point about your property taxes and how to incorporate that in your purchase price, because we do want to be mindful that, you know, a $500,000 home in Los Angeles might actually have a very different payment than a $500,000 loan in Texas. So keeping in mind that how much it's going to cost to insure that property, and your real estate or property taxes will be a component of your monthly payment that is calculated separately from your loan amount. Mm-hmm. So that's how we want to make sure we're budgeting for that. Aside from that large lump sum, so that 40% down payment that I know was a big surprise for you, did you have any other surprises or unexpected expenses that came up during the process? That's a very popular question that I get.
Yeah, I mean, I think I was really naive about how much paperwork and different steps were in the process to buy a home. And so there were a lot of unexpected expenses. And I mean, now that people have been through this workshop, hopefully they can anticipate them better because you've outlined a lot of them. But for us, it was like the inspections process. I you know, thought, okay, maybe we pay a couple $100 or $1,000 for somebody to come inspect the home. Well, then we bought a home with a pool, and they're like, okay, you need a specialist to come out and do a pool inspection. And we're in LA, our fireplace had apparently been damaged in the 1994 Northridge earthquake. So they recommended a specialist fireplace inspection. And so like each one of these extra inspections was several $100s, and just added on to costs that I hadn't really anticipated. And also from just a time perspective, I think going through that process in the month from having our offer accepted to closing on the loan, getting all of those inspections done, negotiating, we had a 2-week European vacation planned in that same time period. And so I think in hindsight, you know, I guess you never know when your offer is going to get accepted. We had been through multiple offers that we had not won the bidding process on the home before. So timing wise, that wasn't the best decision. And I would say if you're serious about buying a home, like make sure you're devoting not enough money for those closing costs and unexpected expenses, but also enough time to kind of go through all of that process. And also renovation costs. Like there were things that came out of those inspections that we wanted to fix, right? There were some issues with our swimming pool or an electrical thing or a gas line issue. And we just didn't feel super safe moving into the home until those issues had been resolved. And so making sure that if you are buying a home that's older or that might need some repairs, that you're setting aside some budget for that or trying to negotiate it at the end of the process.
Yeah, another excellent point. Buying a fixer-upper versus a turnkey home is certainly going to make planning a little bit different in terms of the extra cash that you're going to have available for those renovations or those projects. So that is super relevant, but also kind of brings us back to basic like financial fundamentals. We talked a lot about cash needed to close, what goes towards the down payment, what goes towards closing costs, having cash for incidentals. But from an emergency fund standpoint, just like a foundational finances, having cash savings, I always recommend 3 to 6 months worth of your expenses. And in many cases, I'll tell someone, if you're a renter, if you have highly transferable skills, you're a W-2 employee, 3 months is probably sufficient. However, homeowners, those who have children, other circumstances, 6 months makes a little bit more sense, because as a homeowner, the chances that you're going to have an emergency go up. So there's always the importance to have that additional cash on hand always. You may possibly find yourself in a situation where your monthly expenses are increasing, therefore the amount you should have in an emergency fund is increasing. And be prepared that the likelihood of an emergency is going to be higher as a homeowner than not. My best friend, within like 3 weeks of owning her condo, the dishwasher flooded. And when she had been a renter for the 15 years, it was like, oh, dishwasher flooded, let me call the super. Nope, it was all her. And you have to be prepared for those little things. But with all of that in mind, there are probably a million different examples that we can share and things that would be absolutely applicable to everyone here. But if you had to pick like just high level best tips you have for anyone else who's going through the process right now, what would you say to others who are currently looking to purchase a home?
Yeah, I would say just do it as soon as possible. Crunch the numbers and set yourself up for success. But I did have to pay off my student loan balance as part of the closing process to get my mortgage approved. And I wish that I had not opened some extra credit cards in those 3 to 6 months beforehand, because it just led to more paperwork. I had to like pull all sorts of statements for every bank account and savings account and investment account that I had as part of the process. And I just wish that I had been more prepared and done it sooner, because we did buy a home that we know is not our forever home. It's not in a great school district, and we initially did buy with a 7-1 ARM, and then recently refinanced to a 30-year now that the rates are really low. That's a great tip for everybody. It is a really great time to be buying a home right now. Like, these are the lowest rates in our entire lifetime. So I think that's definitely there. But yeah, I wish that I had just figured out a way to buy sooner, even though I wasn't sure which city I was going to be staying in. I think there's a lot of opportunities to turn your first home that's maybe not your dream home into a rental, and just kind of build your wealth and equity that way.
So many opportunities to approach home ownership in this case. And thank you so much for sharing all of that. It was undoubtedly hugely valuable to everyone else who's joined us. We love all of your support and advocacy for SoFi, and we really appreciate you being an ambassador and joining us today. So thank you so much, Jen. We really appreciate it.
Thank you.
And I'm cognizant of time, so for all of you who have joined us, all of you who have submitted questions, I do see that we are bumping up close to the end of the hour. So Paige, I would love to ask your permission for those who are willing to stay on the line, perhaps a little beyond our scheduled end time. I am more than happy to make myself available to answer as many questions as we can get to. So if you're ready and you think we can make that happen, let's dive in. And for those of you who are able to stay on the line, we will try to get to as many of these questions as we can.
I think that sounds great. And then just a reminder for those of you who do have to drop, you have access to meet with financial planners like Lauren to ask any questions that you possibly want. And it's completely complimentary. So you just have to visit this link here, sofi.com/sofinancial. But without further ado, why don't we just kick off Q&A? So Lauren, we have so many questions. I have never seen more questions in a webinar before, so brace yourself. So our first question, should 25 to 30% on monthly income also be targeted for mortgage payments?
So that, I think that 25 to 30% is a great range. When we talked about the ratios earlier, my goal is to make sure that you're capping your housing at 28% of your gross monthly income. So if you're looking at 25 to 30%, that's a fantastic range. Also remember, we don't have to go that high. So if you find something that you love and you're able to do that for 25% of your income to cover your housing, fantastic. That just means that there's more for you to save or spend on other things. But we want to be realistic. We are looking at a gross or pre-tax number, but 25 to 30% is a fantastic target.
Great. Okay, our next question, how to prepare your bank account to show lenders?
Sure. So I know I mentioned this a little bit earlier on when we were talking about kind of mattress money. So cash that you have, maybe you recently got married and received a lot of gifts in the form of cash, or you've just always kept it a habit to keep cash in the house, or you're paid in tips, whatever the case may be. Please make sure that any cash, and this is going to include gifts from family members. So if your parent or grandparent or in-laws, whoever has said that they're going to give you a monetary gift to help you out, that's going to go towards your down payment, get that money as soon as possible. Get it in the bank as soon as you can. Chances are, if it happens within a few months of when you apply for the loan, the underwriter or lender is going to ask you for that gift letter, as I had referenced earlier. But the sooner you're able to see it in your account, the better off you'll be. Other than that, I would just try to kind of keep things simple. A lot of future home buyers like to have different accounts because they want to keep money for their down payment in a separate savings account in a separate bank. And that's fine. But if you can try to consolidate some of your assets, it's just going to make it a little bit simpler for you. And more easy for the underwriter to understand exactly where all of your assets are and how to account for them. Same thing goes for if you're taking out a loan against any assets. So if you are going to leverage a 401k loan for that down payment, make sure that you apply for that 401k loan, you receive the check, and you deposit it in your bank account as soon as you can in order to show that the funds are there. You'll also want to keep a copy of the check so that you can show them exactly the source and where it came from. Try to think in the vision of the lender. They want to understand that these are legitimate sources. They want to know that this came from you. It's not debt, and they need to be able to kind of check the boxes that they've done their due diligence on where this money has come from.
Thanks, Lauren. Okay, our next question is, it's still not clear on the pros and cons of the FHA versus traditional 30-year fixed loan. So can you kind of explain that if you had only 5% down?
Yes. So didn't have an opportunity to get deep into FHA, but I will do that now. So an FHA loan is structured to really help home buyers who would otherwise struggle or need a little bit of assistance into getting into a mortgage. An FHA loan needs to meet certain criteria, but it does usually have a lower down payment. So an FHA loan is usually going to have a minimum down payment of 3.5%, where otherwise your minimum down payment for a conventional would often be 5%. You can also acquire an FHA loan with a lower credit score than what you would be able to qualify for on a conventional mortgage. FHA loans do come with certain protections. So kind of what's happening with coronavirus right now, people who have an FHA loan may have a little bit more government-backed protection, right? So there's a little bit of security that you won't be evicted from your property because you do have a loan that is backed by the government. There are also going to be really competitive rates because, this FHA program exists to promote home ownership. And it does give you the option to have co-borrowers who may not live with you. So that's what's called a non-occupied borrower. So this would be like if a parent or sibling is trying to help you out and they apply for the loan with you to help you get qualified. It's someone who doesn't live there. And that's not something that's always available on a mortgage. So if you are younger and you're relying on someone to be basically a co-signer or co-borrower with you, an FHA loan may be a little bit more flexible if that person's not going to live in the house and have it as their primary residence. Now, there are, of course, downsides to an FHA versus conventional. FHA process does take a little bit longer. You're going through the government. So they're not necessarily the fastest at processing things. So you might be looking at a longer closing time, which could make you a slightly less attractive borrower. So if you're going in and making a bid on a property and you're going with an FHA and someone else is going conventional, that buyer may be inclined to go with the conventional, the seller may be inclined to go with the bid from the conventional loan versus FHA. FHA loans also are a little bit nitpickier about going through their appraisal process. So if you have an appraisal on the property, which you would need to do going through the process, you can usually only use an FHA approved appraiser, which may come with different costs and also might be a little bit harder to schedule, could delay the closing process. Also a very important cost related issue with FHA versus conventional. If you put less than 20% down, whether you have an FHA loan or a conventional loan, you will be subject to PMI or private mortgage insurance. With a conventional loan, you have the expectation or the ability to drop that PMI, that monthly cost, once you achieve 20% equity. So a conventional loan might have your PMI automatically drop off after 10 years, or once you hit 20% equity, you pay for appraisal, you send it to the lender, and they will remove that PMI from your monthly cost. So your mortgage payment actually goes down. With an FHA loan though, that PMI stays on your payment for the life of the loan. So if you get a 30-year fixed loan and you keep that home and you're paying PMI because it's an FHA loan, even if you have paid down 50%, you have 50% equity in the property, it doesn't matter up through year 29 through that very last payment on the mortgage, you're paying PMI. But I think that probably covers the main or most important differences. To recap, FHA is going to be helpful for those who have less to put down, potentially lower credit, need to add a co-borrower who's not going to be an occupant, and will come with a very competitive interest rate. Downsides being logistically can be a little bit more difficult to get approved or a little bit more time consuming. It may not give you as much of an edge as a buyer when you're making a bid. And from a cost perspective, if you are subject to PMI, that PMI is going to stay on the loan for the life of the loan, regardless of how much equity you wind up having. So I hope that answered that. That was a lot.
That was a lot. Okay, a question that just came in was asking about jumbo loans. So do any of these numbers about down payments and PITI change if you're talking about jumbo mortgages in more expensive housing markets?
So the PITI wouldn't change, in terms of affordability. If you're looking at a jumbo price range, in terms of like calculations from an affordability standpoint, from a ratio standpoint, that wouldn't be any different, where you're likely going to run into not different calculations or formulas to get to that point, but things to consider if you're looking at a jumbo loan versus a conforming loan would be doing a little bit more of your own research on insurance and real estate costs. So taxes and insurance, the TI of the PITI, may be much higher. So you do want to make sure that if you're trying to calculate what that monthly mortgage payment would be, do not rely on calculators on Zillow or on any other real estate website. You want to look at the individual NMLS listing, and you want to find exactly what the real estate taxes are for that particular property, calculate what it would be on a monthly basis, and factor that into your calculation. If you're looking at, in an area where, higher likelihood of fire, higher likelihood of earthquake, higher likelihood of flooding, you do want to take those things into consideration and get a more realistic kind of estimate on what it would cost to insure that property. A lot of these basic calculators, if you use something that's like on Remax website, on Redfin, on Trulia, they're gonna plug in a very generic number. They're not using, they're not always using data based on that particular zip code or in that type of property. So you may be drastically underestimating the cost of both taxes and insurance. And with insurance, we want to keep in mind it's not only your homeowner's insurance, but also PMI if you are subject to that. So those are the kind of like the primary things that I would consider if you are looking in the jumbo range. The good news is jumbo loans are extremely competitive. You're probably looking at an excellent rate. Depending on the lender, you might have a little bit more flexibility with what you put down. But in order to make sure that you are making accurate calculations, make sure you do your own research on, especially when it comes to real estate taxes.
That's great. Okay, our next question, and this I think came in when you and Jen were doing your Q&A. Are there any thoughts around strategy when buying your first home, knowing it isn't your dream home? So for example, you might buy another home in the next 5 to 10 years.
Yeah, so this is really what I was alluding to when I said, when you go through picking your mortgage product, let's be realistic and keep in mind that if you are in a starter home, you're in your first home, chances are you might be there 4 or 5 years. And whether you wind up holding on to that property as an investment or selling it, chances are you're going to, at the very least, going to refinance that mortgage. So what's most relevant is less that you might move and more that you are getting into a mortgage that you will likely only have temporarily. So this would mean that having the lowest possible rate is probably not going to be your highest priority, because you're only going to have that rate for 4 or 5 years. So one of the most relevant decisions to be made is often around whether it makes sense to buy down your rate with points or take a slightly higher rate. If you know that you're going to that you're a first-time home buyer, you're likely only going to be in this loan for a few years, or you're going to hold on to it as an investment property, which would likely result in a refinance anyway, then it might make sense for you to take another loan that has a slightly higher rate or not pay any points up front and keep that cash, even though it will have a slightly higher rate. It'll keep more liquidity in your pocket, fewer out-of-pocket costs, lower cash to close, because when the buying down the rate is going to be most valuable is when you know you're going to hold on to that mortgage for a very long period of time. So that's the primary thing that I would consider to be when choosing between products. If you know it's a starter home, I would keep in mind too, a lot of people spend a lot of time shopping around because they're looking for the perfect starter home. And I just don't know that anything exists. Like you want to find something that fits your lifestyle and something that'll work for you. You don't want to hate where you live. But if you go into it knowing that this is going to be a learning experience for you and you're not making a very long-term commitment, I'd probably not stress too much about finding what's perfect and focus more on what works for you now, with the knowledge that you are prepared to go through the process again in a few years.
All right, I think we have time for about one more question. But before we get to that, just a reminder, everyone, please take advantage, meet with a financial planner. I can't even tell you guys how many questions we have that we haven't gotten to, and I sincerely apologize. We want to be able to answer every single one of them. But in order to do that, we would have to be in this webinar for probably 5 hours. So Lauren, let's just wrap it up here with one final question. Does not paying 20% down payment put you in a disadvantage to securing a house? Does the home seller or the real estate broker know this? Is it going to put you in a disadvantage? What are your thoughts?
So amazing question. In my opinion, absolutely does not put you at a disadvantage. The seller will not know how much you're putting down. So the seller and the seller's agent, even your agent, will not know exactly how much you're putting down. What they will know is what type of loan you will have. So if you do go with an FHA loan versus a conventional loan, they will know that. And typically, if you have 20% to put down, you're going to be in a conventional loan, but you can have a conventional loan with as low as 5% down. It's very rare that someone who has 20% equity is going to pursue an FHA loan. So generally the assumption might be, if you have an FHA loan, that someone is putting less than 20% down. If you have a conventional, whether it's 20% or not, this person qualifies for a different type of loan that has the ability to close sooner. So people will not have that level of transparency. They won't know if you have 20% or not, but they will know what type of loan that you have. And as a reminder, if you qualify for a conventional, that is going to make you a more attractive buyer. So I know Paige said this. For all of you whose questions that we didn't get an opportunity to get to, I'm so sorry. I wish that we could stay on, but you can use this link to schedule an appointment with myself or any one of my colleagues, and I would be more than happy to answer any questions that you submitted and any additional questions that you have. So please don't be shy. Feel free to schedule a one-on-one appointment whenever it would be convenient for you.